Hello there. As we know that in UAE, both VAT and corporate tax allows for a tax grouping, but they are entirely separate concept with different rules, criteria, and implication. In today's video, we will try to learn the aspect of VAT tax grouping and corporate tax grouping and their rules and criteria. The benefit for VAT tax grouping is to simplify VAT compliance by treating related entities as a single taxable person, means VAT will not be applicable on any transactions taken place between the companies of the same group. And on the other hand, under the corporate tax grouping, once FTA has approved the application for the UAE resident companies to form a tax group under corporate tax, they will be treated as a single taxable entity, and any internal transactions will be eliminated for the purpose of computation of a tax liability. For VAT tax grouping, one TRN covers the whole group. Individuals do not separately register while they remain in the group. But on the other hand, corporate tax grouping, each legal entity must first be registered for corporate tax, and then they can be part of a group. The group is then treated as a single taxable person for corporate tax purpose. Recent Ministerial Decision 301 of 2024 updated the corporate tax group rules that affected from tax period from 1st of January 2025. VAT tax grouping can be formed by two or more persons conducting businesses, may apply to treat it as a VAT tax group, and the FTA issue one TRN for the group on the fulfillment of the certain conditions. And the conditions are the control criteria, that is, holding company must have more than 50% of control of other in terms of voting rights, board composition, and profit entitlement. And in context of corporate tax, the control is more robust, as a parent company must have more than 95% of direct or indirect ownership, voting rights, and profit entitlement. Importantly, the FTA issue single TRN for the tax group. Individuals members are not separately registered for VAT while in a group. Internal supplies between the group members are generally disregarded for VAT. But this is not same for corporate tax grouping. Whereas corporate tax law treat certain related entities as a tax group, a single taxable person, if strict ownership, control, conditions, and other requirements are met. Individuals registration first, each member must be registered for corporate tax and have a CTRN before joining a tax group. This is a big difference between corporate tax group and VAT group. Generally, the parent must hold more than 95% of the ownership, voting rights, and entitlement to the profit, net assets of each subsidiary. The 95% test is in Article 40 and 42 and ministerial decision. Some tax period and accounting basis where the members and the parent company both must share the same tax period and prepare their financial statements on the basis of IFRS. Once a group is formed, the parent files consolidated corporate tax return. Internal group transactions are generally eliminated for computing the group's accounting taxable income subject to detailed rules. For example, pre-grouping losses exemptions are also available. Pre-group tax losses under the Ministerial Decision 301 of 2024 clarifies how pre-group losses are treated, limits and mechanism. Ministerial Decision 301 replaced earlier guidance for tax period beginning on or after 1st January 2025. Effect on input tax credit, yes, full recovery if all supplies are taxable within the group in context of VAT, but there is no implication in terms of corporate tax. All the free zones companies are allowed or eligible to be part of a group? Yes, in terms of VAT, a free zone company is not in a designated zone. But in context of a corporate tax, yes, free zone company, either they are in a designated zone or not, can be part of a tax group in context of corporate tax, but it may assess their effect on the qualifying free zone person status. Is the foreign entities can be included in a tax group for VAT context, not in the corporate tax context. Only UAE resident entities are allowed to be part of a tax group. Impact on external transactions, VAT applies as usual on supplies to customer or third party. And on the context of corporate tax applies on consolidated income, taxable income as per rule of 0% or 9%. In the next video, we will perform a practical example to make it more clear. Thank you.